We're going to begin chapter 8 today. We will complete it on Thursday as we start talking about pricing. A lot of times we've talked about in this chapter, we've talked about the gross margin, but really we're going to take time to determine how are goods priced and how do we determine that pricing. So we're going to look at a variety of manners in which we can determine that in this chapter. Let's start by talking about pricing goods for external sales. The price of a good or service is affected by a lot of various factors. The gain of market share, the environment, various costs that we got to look into, and the demand. Regardless of whatever factors may be involved in here, the price needs to cover the cost of goods sold and also earn some profit. So when you think about it, competition can play a role in how we can market goods, how we can price goods. Do you think Apple, when they started out with their tablet, and there wasn't quite the competition, do you think they were able to gain a pretty good market share and a pretty good profit on that? And then as the market started flooding with various other tablets, the prices have gone down some from when I bought it, I think. So what else is happening in the market conditions, the supply and demand really has a say in how they can price their products. But ultimately, no matter what, they need to earn money. The goal in business is to earn money for a return of investment for those shareholders. The price of goods or services is affected by lots of different ways. Companies must have an understanding of the market and the various competitors in the market. Where products are not easily differentiated from competitor goods, prices are not set by the company, but rather by the law of supply and demand. Such companies are called price takers. Where products are unique or clearly distinguishable from competitors' goods, prices get set by the company. Pricing plays a critical role in corporate strategy. For example, almost 50% of tablet computer users say they use them to read newspapers and magazines. And since Apple's iPad tablet computer at one time represented 75% of the tablets being sold, Apple felt like it had the newspaper and magazine publishers right where it wanted them. So it decided to charge the publishers a fee of subscription revenue for subscriptions sold on Apple's App Store. Publishers were outraged, but it didn't take long for someone to come up with their rescue. Within 1 day of Apple's announcement, Google announced it would only charge a fee of about 10% of subscription revenue for users of its Android system. That might at least partially explain why Sports Illustrated provided an app to run on Android tablets before it provided one for iPads, even though Android tablets only had a small share of the market. Do the substantially different prices that Apple and Google charge for a similar service reflect different costs incurred by each company, or is it the price difference due to something else? Why does Apple charge a 30% subscription rate and Android only charges a 10%? I'm sorry, what? To get other users. Android charges a cheaper rate to get other users to switch to their products. Why does Apple think they can charge 30%? Their brand. Because of their brand, they believe they can sustain that. How many of you guys have an Apple product? How many have an Android or another type? What? Do you guys think Apple is superior? Come on, guys, let's open this up for conversation. Is Apple superior? Yes, no, I don't care. No. Yes. How many say yes? How many say no? Why do we think Apple is superior? exposure, brand recognition, customer service. Isn't it interesting how we're willing to pay extra for something because of whatever of those intangible benefits we assume? I honestly, I don't know why I like Apple. I've hated Apple. I have been one of these anti-Apple people until I got my iPad. And then I was hooked because it was easy to use. Then I decided to get an iPhone because it all was syncing together. I can't get an Apple computer because so much of my software is done with, it won't work through a Mac, so there's no sense in doing it. But I like just the ease, and to be really honest with you, this is like embarrassing to tell you. Do you know why I like Apple so much? My kids taught me how to use it. I had one of the, I don't know what the smartphone was. I never knew how to use it. So I never used it. Now I text all the time and it syncs, and maybe some of it is because my children had a liking to it, and as a result, it's become favorable for me. Not necessarily good reason, but it's where I'm at. But Apple can charge 30%, right? Target costing. Laws of supply and demand significantly affect product price. Ultimately, to earn a profit, companies need to focus on controlling costs, reducing the costs that go into the product. That requires setting a target cost that will provide the company's desired profit. Target costing. Costs that provide that desired profit when the market determines a product's price. So when the market's going to determine our price, what is the only thing we can control? The cost, that's all. So we are going to do target costing by taking our market price minus whatever we hope the profit we want to get to determine what cost we're going to be able to use for this product in order to sell it at the market price. If a company can produce its product for the target cost, it's going to meet the profit goal. So what do we do with target costing? First, company needs to identify the market niche where it wants to compete. It conducts market research to determine what that target price is. And then the company determines its target cost by setting that profit, and the company assembles a team to develop the product to meet the company's goals. Walmart says the price is too high. I have known so many clients, they hate working with Walmart. They love working with Target because Target's willing to purchase their goods at the price they need. Walmart won't. Walmart wants cuts. Here, as the price, Walmart says, and the price should be $19 per pair of jeans instead of $23, says the retailer Walmart, to jean maker Levi. What happened to Levi Strauss is what happens to many manufacturers who deal with Walmart. Walmart often sets the price, and the manufacturer has to find out how to make a profit given that price. In Levi Strauss's case, it revamped its distribution and production to serve Walmart and improve its overall record of timely deliveries. Producing a season of new jean styles from conception to store shelves used to take 12 to 15 months, but now it only takes 10 months for Levi's, for regular Levi's, to time. The time is down to 7.5 months. As the chief exec of Levi Strauss noted, we had to change people and practices. It's been somewhat of a D-Day invasion approach. So they need to basically ultimately just reduce their costs in order to meet what Walmart wants to set the price at. So Walmart here is the price setter, aren't they? Fine Line Phones is considering introducing a fashion cover for its phones. Market research indicates that 200,000 units can be sold if the price is no more than $20. If Fine Line decides to produce the covers, it will need to invest $1 million in new production equipment. Fine Line requires a minimum rate of return of 25% on all investments. Determine the target cost per unit for the cover. So the desired profit for this new product, $1 million at 25% means the 250,000. So each cover needs to result in a $1.25 profit. How are we going to determine that? If we know the market price can be 20 and we want a profit of $1.25, our target cost has to be $18.75. Target costs relate to price and product means that target costs related to price and product mean that cost and desired profit must be determined before selling price. Cost and selling price must be determined before desired profit. Price and desired profit must be determined before costs. Or costs can be achieved only if the company is at full capacity. What do you guys think? Price and that desired profit must be determined before costs. Cost plus pricing. In an environment with little or no competition, a company can set its own price. When a company sets its own price, the price is normally a function of product cost, or you call it the cost plus pricing. Approach requires establishing a cost base and then adding a markup, which ultimately determines the target selling price. So the cost of the product plus what the markup is on the product is going to equal what we target the selling price to be. We get to use this when we get to set the price. In determining the proper markup, a company must consider various factors. The size of the markup depends on the desired return on investment. So return on your investment is going to equal the net income divided by your invested assets. So our selling price minus our cost is ultimately going to equal our profit. Hang in there, guys. Think More Products is in the process of setting a selling price on its new video camera pin. It is a functioning pin that will record up to 2 hours of audio and video. The per unit variable cost estimates for the new video camera pin are as follows. We've got direct material, direct labor, variable manufacturing overhead, and our variable selling and admin give us cost per pin of $60. In addition, Think More has the following fixed cost per unit at a budgeted sales volume of 10,000 units. So we need to add to that $52 if we produce 10,000 units. Now let's say Think More has decided to price its video camera pin to earn a 20% return on investment, or 20% of $1 million, which is their invested assets. So the expected return on investment would be 200,000, which would be 20% of $1 million. But to break it down per pin, we take 200,000, divide that by 10,000 pins, means we want a return of investment of $20 on each pin. So if we take all of our costs, that means we need to sell this video pin for $132 to break even, or to meet our goals, our objectives. Use markup on cost to set a selling price. We compute the markup percent to achieve the desired return on investment of $20 a unit. We add to that our costs to determine what our markup percent is going to be. So return on investments is the desired markup on invested assets. This then transfers over to the amount we need to mark it up per pin, but this is the markup percent per pin. So return on investment is going to be different than the markup per unit, okay? Compute the target selling price. If we know our costs are at $112 and our markup percentage is at 17.86%, or our 20 bucks. That helps us determine what our selling price. So guys, we're basically doing the same thing, just with different variables that they give us. What are the benefits? It's easy. But what are the disadvantages? Does not consider the demand side. What's the customer going to pay for the product? Fixed cost per unit changes with change in sales volume. So we know that when we're dealing with fixed costs, we're estimating 10,000 units as a volume. But what happens if we up it to 15,000 units? That's going to reduce our fixed cost per unit, won't it? Right? And what happens if we, instead of produce 10,000 units, we produce only 5,000 units? It's going to increase our fixed cost per unit, won't it? Fixed costs are constant, but based on the unit volume, it's going to increase or decrease per unit. Let's take an example here. If budgeted sales volume for Thinkmore's products was 8,000 instead of 10,000, Thinkmore's variable cost per unit is going to remain the same. However, the fixed costs are going to change. As you can see, now our fixed costs are going to go up to 65 bucks per unit. Thinkmore's then desired 20% return on investment is going to be, if we have to take a 20% return on investment, but we've got to divide that by only 8,000 pins instead of 10,000 pins, then that means we need to mark it up an extra 25 bucks per unit instead of what we originally had as $20 per unit. Any questions on what I'm talking about? Thinkmore computes the selling price at 8,000 units based on our variable cost, our fixed cost, our desired rate of return on investment, to mean our new selling price needs to be 150 bucks. At 8,000 units, how much would Thinkmore mark up its total unit cost to earn that? 20%. So at 8,000 units, it's got to mark it up 20%, which is similar to the return on investment they're wanting to get. Then there's another way we can do this, variable cost pricing. Alternative pricing approach adds a markup just to the variable cost. So basically, it doesn't take into account the fixed cost. It basically takes the variable costing and adds a markup just to those. Special orders that we've already talked about don't take into account fixed costs usually, because the special order's happening and it's going to be based just on variable cost. That's going to be an example like this. The disadvantages is that managers can set the price way too low because they're not covering any fixed costs. So let's look at KRC Air Corp. They produce air purifiers. Using a 45% markup percentage on the total per unit cost, compute the target selling price. It gives us the direct materials of 16, the direct labor of 18, the variable manufacturing costs of 11, fixed of 10, variable selling of 6, and fixed selling and admin of 10. So we've got $71 is the total unit cost, okay? Now it wants to use a 45% markup on the total unit cost. So how are we going to determine that? If we take our unit cost of $71 and we determine the 45% markup on that, that means we would have to sell this product for $102.95 per unit. Because 45% of $71 has got to be $31.95, right? Cost plus pricing means that the selling price is going to equal variable cost plus markup percent plus variable cost, or selling price equals cost plus markup percent times cost, or selling price equals manufacturing cost plus markup percent plus manufacturing cost, or selling price equals fixed cost plus markup percentage times fixed cost. What do you guys think this one is? Do you think it's C? What do you guys think? Who says C? Who says A? Who says B? B. Manufacturing costs don't include fixed and variable selling and admin, do they? Manufacturing costs just include the direct materials, labor, and manufacturing overhead. But we're dealing with all costs here. Pricing, yes. Oh, are you stretching? Time and material pricing is an approach to cost plus pricing in which the company uses two pricing rates. One's labor used on a job and one's for materials. This gets used in service industries such as accounting and law firms and engineering firms. So for example, the following data for Lake Holiday Marina, the mechanic's wages and benefits $103,000. The material loading charges of parts managers is in the loading charges, and a portion of the office employees' salaries gets put over to material loading charges, but most goes under time charges, and then all the various overhead gets dispersed. So using time and material pricing involves 3 steps. Calculate the per hour labor charge, calculate the charge for obtaining and holding material, and then calculate the charges for a particular job. Calculating the labor charge basically happens by an hourly rate. It's going to include direct labor costs, selling admin, and similar overhead costs, which we know are not manufacturing costs, are they there? And then allowance for that desired profit per hour. So if the labor rate is based on 5,000 hours and we desire the profit to be $8 per hour, how are we going to determine the rate we charge per hour? If we show our $20 per hour charge and then we calculate all the various charges, we're at $30 per hour. But if we want a profit of 8, that means we've got to charge $38.20 per hour to make that profit. Okay, calculating the material loading charge. Basically, we're going to take that loading charge and we're going to divide that by the estimated costs of the parts and determine our profit there. So in this case, if the marina establishes invoice costs are going to be $120,000 and we want a 20% markup on those costs, then we're going to take the costs, divide that by our total costs of $120,000 to determine what our percentages of the material loading. I think we need to do some problems. Sometimes that's the best way to get to learn. Let's look at the first problem, 8.2. Let's look at 8.2, and what page is that on in the book, guys? 364? Okay. So on page 364, 8.2, company is involved in producing and selling high-end golf equipment. The company's recently been involved in developing various types of laser guns to measure yardages on the golf course. One small laser gun called Little Laser appears to have a very large potential market. Because of competition, Eckerd does not believe that it can charge more than $90 for Little Laser. At this price, Eckerd believes it can sell 100,000 of these laser guns. Eckerd will require an investment of $8 million to manufacture, and the company wants a return of investment of 20%. So our job is to determine the target cost for one little laser. So it wants a return of 20% of the $8 million. And it believes it can sell 100,000 of these, right? It doesn't think it can charge more than 90. So how are we going to calculate what we can, the target cost for this little laser thing? The investment is what? So the investment is at $8 million, and we're thinking a 20% rate of return on investment, which means how much do we want return on investment to be? $8 million times 20%? $8 million times 20%. $1,600,000. Great, $1,600,000. So if we are going to produce how many units? 100,000 units? What's going to be our return on investment per unit? $1,600,000 divided by how many units? 100,000 units? $16 per unit. So what do we think our target cost is going to be? How much is the most we're going to be able to sell them for? $90? If we want to get $16 per unit, what can we sell them for then? $74 is our target cost. Make sense? Okay, let's look at the next one, which is 8.3. 8.3 says, Hannon Company makes swimsuits and sell these suits directly to retailers. Although Hannon has a variety of suits, it does not make the all-body suit used by highly skilled swimmers. The market research department believes that a strong market exists for this type of suit. The department indicates that the all-body suit would sell for approximately $100. Given its experience, Hannon believes the all-body suit would have the following manufacturing costs. Assume that Hannon uses cost plus pricing, setting the selling price 20% above its costs. What would be the price charged for the all-body swimsuit? So if our costs are at $100 and we want to sell it for 20% above it, what is going to be the price we would sell this for? $120. Are we going to sell any if the going sales price is at $100? Would we even begin manufacturing this? No. Now, number 2 says, under what circumstances might Hannon consider manufacturing the all-body swimsuit given this approach? Why would we manufacture it given this approach? Any ideas? What if it was a special order and we don't have to take into account our fixed cost? Would we maybe then possibly try to sell it because all we care about is our variable costs? Does that make sense? The next one says, assume that Hannon uses target costing. What is the price Hannon would charge the retailer for the all-body swimsuit? So if it uses target costing, what would we be selling this to the retailers for? What's target costing? When the price gets fixed for us, right? What's the going rate to sell it for? Anybody? Anybody? The going rate's $100. Remember how they said that's what they think it's going to sell for? We would have to sell it for $100 if we're doing target costing. Then number 3 says, C says, what is the highest acceptable manufacturing cost Hannon would be willing to incur to produce the all-body swimsuit if it desired a profit of $20 per unit? What is it we've got to sell it? What kind of cost would we only allow if we want to make $20 per unit? $80 is the target cost. Otherwise, we're not going to be able to sell it, right, for what we want to make on it. Any questions, guys? Correct. So basically, if they're trying to use target costing, what is the price that Hannon would charge the retailer for the all-body swimsuit? Well, they gotta sell, in their case, $100 is the target, how am I gonna say that? The target costing, here, one second. Let me make sure I'm saying it right and not screwing you up. The selling price, assume that Hannon uses target costing. What is the price that Hannon would charge the retailer for the all-body swimsuit? Well, if we're dealing with target costing here, the thing is, in this case, we're assuming the price is only going to be $100. Hannon believes the all-body suit would have the following manufacturing costs, but they think the all-body suit would sell for $100, so that's what they're going to have to sell it for. But again, like you said, they're not going to make money on it. They can't sell it for that because they're not going to make money on it. But when you're doing with target selling price, it's going to be what the normal market's going to bear. And they're not going to be able to sell it for that. I mean, they won't make money if they did that. What's our next one, guys? 8.6. Let's look at 8.6 here. Alma's recording studio. Alma's recording studio rents studio time to musicians in 2-hour blocks. Each session includes the use of the studio facilities, a digital recording of the performance, and a professional music producer / mixer. Anticipated annual volume is 1,000 sessions. The company's invested $2,352,000 in the studio and expects a return on investment of 20%. Budgeted costs for the following year are as follows. To Determine the total cost per session. So how are we going to calculate this, guys? Any ideas? Add up the per session costs. So, we're going to start with the total cost per session. So our direct materials are how much? 20. The total cost per session. Here, I just want to read this again, so I know what I'm doing here. 7.6. So our direct materials oops, 366. Our direct materials are 20. Our direct labor's 400. Our variable overhead's 50. Our variable selling and administrative is 40. And what are our fixed selling and administrative expenses? 500,000. And how many sessions do we hope to get? 100. So let's start with total cost per session. Total cost per session is going to be direct materials of how much, guys, did we say? Here, let me just put this here so I can. Direct materials of 20. Our direct labor, 400. Our variable overhead, our fixed overhead is going to be 950 divided by 1,000 is going to be what? $950. Our variable selling and admin is what? And then our fixed selling and admin is going to be the 500,000 divided by 1,000 is what? So our total cost per session $1960, right? Yes, no. Then we go back and it says, determine the desired rate of return on investment per session. How are we going to determine that? ROI per session is going to be 20% of, what are the invested assets? $2,352,000. Divide that by 1,000 units is how much per unit or per session? $470. The next question asks us, calculate the markup percentage on the total cost per session. Well, the markup per session of 470 divided by how much is the cost per session of 1960? How much is that going to be markup percent? you guys think? $24%. So what is going to be our target price per session? You guys look so excited. Our target price per session is $2,430.40. We compute that by our cost of $19.60 plus our desired return per session of $4.70. Does that make sense, guys? Any questions? Absolutely. It tells us what the markup is on the total cost per session. So if we take our $470 is what we need to mark it up per session, and we divide it by the total amount of costs it takes us per session, 24% is what we're marking it up per session on our cost. So if our costs are at $19.60 and we want to make $4.70, we basically are marking up the price of it per session 24% to come up with a profit. Any questions, guys? How are you guys doing? I feel like I need to call it a day. You guys are really... How many want to go on with another question, another problem? 2, 3. Who wants to call it a day? 2. No one's even paying attention. About 20 hands went up and I said 2 and no one even looked. Okay, guys, this is going to be on the, I have this recorded. You guys can listen to this on the Moodle. And what I'd like you to do is go through anything you have questions about. So then when we come back together on